Hey guys, hold on to your socks because up this week is the oh so large and oh so steady Kroger Company. Kroger is a $30 billion grocery store retailer with about a 2% yield. They're headquartered in Ohio and they're one of the largest retailers in the world with annual turnover of about $130 billion. They've got just over 2,700 stores, of which some have pharmacies and some have fuel stations. They're active in 35 states and they serve about 9 million customers a day. All right, everyone's familiar with Kroger, so let's get into the analysis. Okay, so before we open the model today, I just wanted to call your attention to something. More often than not, I hear people talk about price to earnings ratios. And if I mention Kroger, for example, they'll go fire up Yahoo Finance like I'm at right now, and they'll look at this number right here. So 26.85 on a price to earnings basis. Notice that's a trailing 12-month number. And also notice that's based on a trailing 12-month EPS of $1.50 per share. That looks expensive for Kroger, but unless you ask the next question, which is, well, what's it been over time? You're not going to realize this is not representative of what Kroger's really trading at. So if I open up Kroger's long-term financials, you're going to notice that $1.50 per share has not been what they've been making since 2014. Lately, over the last 3 years, they made $209, $376, $204, and $327. So if you average those out, let's say, we're actually at $279. So if you take the $40 a share that's trading at over $279, this is only a 14 PE stock. Way different story than the 26 PE that Yahoo Finance is publishing. Okay, Curtis, get off your high horse and show us the Kroger model. All right, fine. Let's get into it. So Kroger is a $40 stock. They've got about 750 million shares outstanding, $30 billion market cap, and about a $47 billion enterprise value. Currently, Kroger's trading at about 9.3 times enterprise value to EBITDA. Now, 9.3 times is a lot cheaper than Google that we looked at last week that was around 27 times. But as you'll see when we work through this model, if you bought Google or you bought Kroger today, actually, even though Google's higher valued, you can expect to earn about the same return because Kroger is likely to grow a lot slower than Google. So that's why I'm not a pure value investor. The value investor side of me would say 9.3 times versus 27 times I'm buying Kroger all day. But unless you also ask the question about the growth trajectory of the company, you don't get the full picture. You can have a company that's trading at 27 times that's growing really fast, or you can have a company that's trading at 9 times that's growing slower like we're looking at with Kroger, and they can actually work out to a similar return over time. What that means is don't ignore the company that's trading at a higher valuation just because it's higher. You have to understand its growth trajectory before you can make that conclusion. Okay, next up, let's take a quick look at Kroger's debt levels. So they've got short plus long-term debt of around $14 billion, and then they've got operating leases of $7 billion. This operating lease line, this is a new accounting standard where you have to discount and capitalize the operating leases. Operating leases for Kroger would be predominantly associated with the rent that they pay on their stores. So I noticed that at the end of 2021, their net debt to EBITDA ratio, as I calculated, is 1.9. And then I flipped over to their 10K, and I did a search through their notes, and companies typically disclose any material covenants that they have, and you can actually see it right here. So this is Kroger's leverage ratio, net debt to adjusted EBITDA. That's why I like to include this ratio in the model because it's a pretty typical debt covenant that governs bank facilities and short-term credit. So it says here, if this ratio were to exceed 3.5 to 1, we would be in default of our credit facility and our ability to borrow on the facility would be impaired. So that wouldn't be good. So you have to keep your eye on the net debt to EBITDA ratio. Typically, that's very common. And what you want to look for in particular is this ratio rising? And if it is, then why? Is it because the company's actually committed to a dividend that's too high? Or are they buying back too much stock? Or are the operations deteriorating? Is revenue falling or is margins deteriorating? Is cash flow too high? Are they investing too much? That type of thing. So this line is very important in the model. It really is sort of a key gauge on the health of the business going forward. Okay, I'm going to start moving a bit faster through the model. So down into the operating assumptions, revenue is pretty straightforward to model for Kroger. They've had a pretty consistent growth pattern. So if I expand the years here, I can see that, in 2012 they're at 90, then 96, then they were jumped up to 115 by 2017. Then they were 132 by the end of last year. So pretty good. Over a 10-year period, they're at 5%. 4% over a 5-year period, 2% over a 3-year period, and then last year they did 8%. For now anyways, we're going to see how it looks if I leave the 3% growth rate in there at 2.4% per year, but we're also going to flex it at the end. EBITDA margin, it's around 4%. So they had 3.8% trailing 12 month. I'm gonna move that up to 4.1 right now, and the model's gonna interpolate out to 4.1 as well. So that actually increased my internal rate of return, and I'm happy with that. Sometimes trailing 12-month numbers aren't as good as a full fiscal year because you sort of string 4 quarters together, and there's a bit of noise by doing that. Down into the free cash flow section, the only thing when I was reviewing this earlier was this non-operating income line item. I'm going to make that 0. The last 5 years has really muddied the non-operating income line item. So if I go to the income statement, I can see it right away. It's this stuff right here. So the big ones are gain on sale of business, gain on investments. Those are non-cash and they're not recurring. So really, non-operating income should be 0. You do have to make some judgment calls when you're using a model like this. When you're trying to use a common structure to model a lot of stocks, you have to make some standardization assumptions, which I have done, but you still have to cleanse the numbers for reasonability each time you do this. So I'm going to make that 0. I'm going to make that 0 as well. That's good, and that's more conservative. Okay, moving south, I'm going to jump down to CapEx. CapEx looks good. Free cash flow looks good. And then 2021 fiscal year, that just looks like an anomalous year, and I can see it right here. It's in this change in working capital numbers. So that $4 billion of free cash flow in 2021 is not a number that makes sense. So let's go and have a look at the 1.5. If I go to the cash flow statement and I go to the working capital section, I can immediately see it's this number right here, 2021-01, and there was a large inflow in accrued expenses. So what could that be? I think that that's actually related to COVID, deferral of payments for suppliers that Kroger probably did. So they're in the depths of COVID and they're trying to hold cash. I bet you it's because they were trying to defer payment. Okay, so back to the model. So that looks pretty good for free cash. I can see right away that Kroger makes a lot of free cash. This is a healthy business. They've got reasonable debt levels like we went through that are below their bank covenants, and they've got some coverage room on their covenants, importantly, so they can actually increase their debt before the bankers start calling. Moving down into the sources and uses section, Kroger is actually a decent dividend grower. They've been growing their dividend for a long period of time, between 11 and 13%. Can that growth continue? It seems very likely that it can. Right now they have roughly a 2.5 times coverage ratio, and they will be growing their dividend faster than their overall business grows, but if you hold this thing for 10 years, it looks like their dividend still is pretty healthy, kind of 1.6 to 1.8 multiple. Importantly, what they can do is they can also play with the amount of share repurchases they do. So they do about 1.1 billion of repurchases a year. They can turn that off and they can transfer that cash over to growing the dividend some more. The nice thing about canceling shares is that you actually also cancel the dividend associated with those shares. So every time you buy back shares, you actually cancel that dividend yield going forward on the shares you repurchase. So that helps a little bit. So it's a bit of an offset, but they can certainly turn off this share repurchase program and allocate those funds to continue to grow their dividend if they want to maintain this dividend clip or maybe even increase it going forward. Now, is Kroger funded to continue to grow their dividend at this rate and do the share repurchases? The answer looks like it's yes as well. They will actually have to take on a little bit of net debt overall to do it, but it looks like from a 1.9x right now, they're growing to a 2.3x over time. It's pretty stable. And it's significantly under their debt covenant threshold of 3.5 times that we looked at in their notes. So that looks like it's fine to me. The dividend's safe, and actually the share repurchase program is also safe. So what do all these numbers mean from a shareholder's perspective if you were to buy Kroger today? So you can go into the market and buy 1 share of Kroger or as many shares as you like. The math is the same. But let's say you just do 1 share. So you buy 1 share at $40 a share. And then you're going to get that dividend stream over a 10-year period, and it's going to grow at 12%, which is a great dividend growth. Then, based on the growth rate in revenue we're assuming, the margins that we're assuming, and the exit multiple that we've assumed, which is 8.3, which again isn't an aggressively high enterprise value to EBITDA multiple, and it's in line with historic, so there's not a lot of risk there. Well, if that all comes true, then the stock should be worth about $67. If you do that math, you calculate a compounded rate of return of 8% over that holding period, or 8.1%, which isn't bad and actually directly in line with the guidance that the company gives. They tell shareholders that they're targeting an 8 to 11 total return to shareholders over the long term. So this is at the low end of that, but it's certainly in line with what the company is expecting. Okay, so before we conclude on the 8.1, let's just quickly flex it to the downside. So I see 2.4% in revenue growth. That looks like a pretty conservative number already. If I flip over to the graphs, I can see that revenue's actually been growing decently for a long period of time. So this is what a 2.4% growth rate for revenue for Kroger looks like. And I can see historically it's been, this is their year-on-year revenue growth, 10, 7, 10, 5, 6. They had a couple of years where they were pretty stagnant, but overall, 2.4 seems like it's roughly doable. To flex the model, let's turn it down to, I don't know, 1.8. So we'll do 1.8. And because inflation's starting to pick up, let's flex EBITDA margin down to 4%. It's never really been down below that. Remember, this is a company that can pass some of that inflation on to consumers. So there is some inflation protection by being a retailer that sells food. So that looks like it's downside of 6.3%. Okay, so to wrap this up, I like Kroger. This is a stock that has been around for 100 years and could be around for another 100 years. They have an essential service in my view. They make good margin, their dividends safe. This is a boring stock you could buy now and not worry about, frankly. You can look at it in 30 years likely and it'll be worth more, and you can give those shares to your children. Hey guys, that's it for Kroger this week. Thanks for watching. If you like what you saw, make sure you hit that subscribe button and please like the video. It really helps out the channel. That's it guys. Thanks a lot and I'll see you next week. Cheers.